And thank you for joining us today. My name is Natalie Wolf. I'm the Director of Investments at Foundation for the Carolinas. And on behalf of the executive leadership team at FFTC, we thank you for joining us today. If at any time during the webinar you have questions or would like further clarification on a specific topic, we invite you to post your question in the chat or the Q&A window. The webinar is being recorded and the link will be added to the fftc.org website. You can access this by going to Menu, and the link is under Engage, Events and Webinars. I will now introduce Travis Pruitt and Tim Westrich, who lead our consulting relationship at Mercer Investments. Travis will be leading the discussion and will address market conditions and investment performance for FFTC's investment pools during the last quarter and really over the past year as well. And Travis, I will let you take it away.
Great. Thank you, Natalie. Hello, everyone. Thanks again for joining us. If you're back, thank you. If you're new, thank you for jumping on. We'll go through a number of pages. As Natalie noted, we'll give you an update to the end of the quarter. We'll give you a sense of what's going on in the world since to the best we can divine. And then, of course, at the end, we'll be happy to take questions. So I can get my computer to work here. Come on now. Go. There we go. Okay, so I just told you we're going to do market overview. Topics of interest this quarter will be diversification and navigating difficult markets. We thought those were very topical given what's going on in the world. And then, of course, we will talk through the standard pool performance and take questions. So through the first quarter, we did see negative results from global equities. Global equity markets were down 1.3% when taking into account both U.S. and non-U.S. stocks. That was primarily driven to the downside by U.S. equities and even more so U.S. growth equities. So if you think about, excuse me, in our previous conversations, we've talked about the Mag 7, the top 7 to 10 names at the top of the index, and the names that have driven much of the returns for the S&P 500 and for U.S. stocks overall have come from those top names like NVIDIA, Amazon, Microsoft, and the like. Those stocks actually took a pause in the first quarter. There was the seminal event early in the quarter for those securities was the release of the DeepSeek AI tool, AI advancements, if you will, out of China that called into question whether the substantial amounts of capital that have flowed into building AI infrastructure would be ultimately required. And so that caused a pause in those names, caused investors to take a second look. And then we saw as the quarter develop, and in here to April and May, we've certainly seen the impact of political economic issues, the introduction and fluid nature of the tariffs environment has caused some additional ripples through the performance through the first quarter. So we did see U.S. stocks take a pause. Non-U.S. stocks, however, which have performed really pretty well over the last couple of quarters, have continued to perform well. And so you can see developed international stocks were up nearly 7% in the quarter. Excuse me. Some portion of that was through the rising of those individual stocks, and some portion of that was the dollar actually weakened, particularly as the tariffs started to gain some momentum and views on the tariffs started to gain some momentum. The dollar actually lost some value where it had been very strong over many of the last several years. And so we get if you will, a double benefit for non-U.S. holdings, and that will be important when we get through to talk about the diversification. We saw also things like commodities perform really pretty well. Commodities are priced in dollars. We saw those performance go up, and we saw yields actually fall in the first quarter as uncertainty rose. So investors, particularly in the U.S., started to step away from some of those higher flying stocks. They found some solace in, excuse me, it's pollen season and it's getting me. Did find some solace in high-grade U.S. bonds. So you see the U.S. aggregate bond index was up 2.8%. Most of that leadership was in the form of U.S. Treasury bonds performing better than average. For the one-year period, though, even with a bit of a pause, global equity markets are up a strong 7% over the last year, again, led by those U.S. growth stocks up about the same. And bonds have had a reasonably positive environment over the last year as well, up nearly 5% over the trailing 12 months. More of that performance over the full 12-month period was driven more so by the credit components of the marketplace and just by a return to higher yields that we saw coming out of 2023. Even though with a lot of volatility within fixed income, we've basically gotten the coupon plus a little bit out of fixed income for the last year. So we wanted to give just a brief update on, how this volatility is pumped out. So I did mention that the AI narrative changed in the early parts of the quarter as the DeepSeek came out, and you can see that the performance here for the blue line is Nasdaq, the green line is the Bloomberg U.S. Credit Index, which is a bond index. The purple line is U.S. high yield, so high yield bonds or lower quality bonds, and the S&P 500 is the pink line. And you can see, even though there was a dip out of the gate in January, for the most part, it's not a huge event, 3% maybe on total in terms of drawdown from the markets. But as we started to layer on other announcements, particularly around tariffs, starting middle to end of January, the volatility really started to pick up, and we saw, as we began the march out of February through the end of the quarter, and then on into April, you can see the impact to each of these more risk-oriented strategies, investments in stocks and in corporate credit, started to come under some pressure as there was increased uncertainty. And the level of tariffs announced on April 2nd were higher than most had anticipated. But already we've seen fluidity in that marketplace. We've already seen the beginnings of deals announced. We've already seen some pauses. So that uncertainty continues to be a question for the market to deal with and for investors to deal with over the next several months. And so diversification, we think, in this environment matters a lot. And so I won't read these to you, but it gives you a sense of the laundry list of tariff items, and you see big percentage numbers on here where the effective tariffs on products coming into the U.S. was sub 5% for a very long time. Now with 25% tariffs on some places, and in China, if you add them all up, prior to the most recent relief, the Chinese tariff levels were 145% on some goods, and those are taxes. Tariffs are taxes on imported goods, and ultimately that can cause some pressure on both demand as well as costs, and that can put pressure on earnings, and hence why you've seen some of the volatility that you've seen through May. Importantly, while the S&P was down around 4% through the first 3 months of the year, it had a pretty significant drawdown in April, and then as the tariff environment changed, the market basically did a U-turn. It looks like a U when you look on a chart, and we have recovered S&P levels. In fact, I think we moved to new highs in the last couple of days. So when we think about the tariffs, we think it's important just to think about impacts. So you can think about how that might impact your portfolio. As I mentioned, that we think direct impacts really to global growth. It is a tax. That means more dollars paid, all things being equal for a particular good, means you'll have less dollars to pay somewhere else. And so that has the potential to put downward pressure on global growth. And we do think our base case in the intermediate term is perhaps depending on where the tariff levels shake out, is at least a mild recession globally as businesses and consumers deal with and digest the impact of these tariffs. In the short run, particularly if these higher levels ultimately end up being sticky and they're implemented, at a minimum, it means a parallel shift in pricing for a number of goods, and that's inflationary. To the extent that the tariffs get settled, perhaps that inflation, that big change rate of inflation is short-lived. But importantly, that will mean that price levels in general will be higher, and many consumers do anchor to the actual price levels rather than the rate of global inflation. So I think in the short term, it could feel inflationary. Those notions feed the indirect impacts that have, if you will, knock-on effects to global markets and to global economies. I noted before, uncertainty is a key factor, both for across the entirety of the market ecosystem. You think about CEOs that are trying to allocate capital towards building the next phase of their business. if the rules of the road are not well defined, it makes it difficult for them to make decisions. And in fact, some of them have pulled back from capital decisions and from guidance in the face of waiting for better certainty on where the tariff levels will fall. Uncertainty that then, I just alluded to this, not only does it impact consumer business confidence and therefore potentially reduces their expenditures, it also puts risk asset prices on alert as well, because again, you have less certainty about what's going to drive your earnings growth or what's going to drive your cost factors, what's going to drive demand, and as a result, that should put some downward pressure on risk assets. So the sooner we can get through the tariff conversations globally, the better off both the economy and markets will be. So what's been this? I'll go through this quickly. There's a lot of data here, but this, what's been the market reaction? And this, again, this is data through just about the end of April. You can see U.S. equities. I mentioned, the market basically did a U-turn, and now there is discounting less bad news as a result of market activity through the end of April. I think that remains to be seen, but the market got a whole lot more sanguine about prospects as the April storyline developed. We've seen yields, generally speaking, come down. This is the 2-year, which is the blue line, and the 10-year is the green line. You can see that yields have basically come down, or the trend has been lower, but there's been quite a lot of volatility as investors, again, try and digest where the world's going. And high yield spreads, while they are up off of the most recent low levels, they have backed off again as investors have gotten a little bit more sanguine about the direction of the economy. What is showing a bit more, if you will, pressure is on the price of oil. We've seen some pressure on the price of oil more recently. We think that is driven by twin items of both potentially lower demand based on the items I've already talked about, as well as OPEC, realigning their supply relative to more recent agreements they've made as a group. So those combined factors have pushed oil down to around $60 a barrel. It's actually been south of $60 a barrel, and that, all things being equal, for the U.S. economy, that's a plus. We use a lot of oil, both in goods and in services. And so that would be actually a counterbalance to inflationary risks for the marketplace. And then I mentioned the dollar has weakened. These are the rates, U.S. dollar to Japanese yen. So you can see that the dollar's fallen just in terms of trend and magnitude, and the number of the euro to the dollar has grown. So both of those reflect the fact that U.S. dollars weakened, and some of that is, again, just reaction to current political environment and what that might mean to different countries. So these are all things that we continue to watch. I think we'll also all expect to see these relatively volatile until we get more certainty as to where the tariff regime goes. So that feeds us into our interesting topics of the day, and we think this is a really important thing to cover today because there's a lot of short-term movement, and there's been, certainly in the midst of early April, when the markets were down when S&P 500 was down in almost bear market territory, we did get a lot of questions of, should we be realigning? Should we, what should we do here? And part of our response is we need to build our ship before the storm comes so that we can ride through it. It's very difficult to put a new plan in place in the middle of volatility, and we try not to do that because the damage can be quite substantial. And I think this is a great chart to talk through that. So these are the blue bars are the calendar year returns for the S&P 500 going back to 1990. And you can see that more often than not, the bars on a calendar year basis are positive, and there are a few meaningful negative periods along the way. But most importantly, is even amongst the years where returns for the full calendar year were positive, there were meaningful drawdowns in intermediate periods within the calendar year period. So I'll use 1997 as an example. The S&P 500 was up 33% that year, but in a short stretch during that calendar year, return for the S&P was actually down point to point 11%. And in the next year, when the S&P was up 29%, it actually had a 19% drawdown period. So these things matter, and a colleague of mine describes it. There is, with equities particularly, there's no pain, no gain, and these pink dots are what can be considered some of the pain along the way. You do get drawdowns. even in bull market environments or strong equity market environments. You get drawdowns in drawdown markets environments as well, but it's not a good way to know when those are coming, and there's not a great way to know whether you're in 2007 where you're up 10, where you're down 10 but you were up 5 for the year, or 2008 where it was much more dramatic. So it's important in our minds to build before before you need it, and to recognize that over multiple periods of time you can get great calendar year results and still live to pretty meaningful downside volatility. That's I suppose that's important for your emotional health, which is a big part of this role, but it's also important from actual ensuring that you're standing in the place to regenerate return when you need to be. And so we take a look at this another way. We're looking at equity returns in a historical context, and we're going to look at long-term returns, but we're going to exclude along the way some of the best performing periods. So from the end of 1959 through March of 2025, the S&P 500 annualized 9.1%, including dividends and income. And if you missed just the 5 best trading days over that very long time horizon, I'm not going to do that math in my head, something like 60 to 75 years, you would have given up about almost 1 percentage point in annualized return. And that might not feel like that much. 8% is a really pretty good number. But if you invested $100 at the end of 1959 in the S&P 500, what that means in wealth over that period was you dropped from about just shy of $30,000 in total wealth to something south of $20,000 in total wealth. So just a less than 1% return difference over such a long time period results in about a third less wealth as a result of missing just those best 5 days. If you miss the best 10 days, you drop basically a little over 1% from the total period, but your wealth drops by half, and you can just see how the math works out. If you miss just the best 50 days, and it's an awful lot of days between 1959 and 2025. If you miss just the best 50 days, you may be doing no better than cash, but with a whole lot more volatility through the S&P 500. So staying invested, staying engaged in your portfolio strategy, it's why we spend so much time talking about strategic allocation and why we build diversification into portfolios, because we just don't know when those best 5 and 10 days are. And missing those markets can have a significantly negative impact on your long-term success against your objectives. And they tend to come in bunches. So this might be hard to read, but I'll be brief on this page. The top 10 bad days from through the 2008 drawdown were oftentimes coupled with the top 10 good days. So if after the second bad day here in September of 2008, you just pulled the ripcord and got out of the way, you would have immediately missed probably, what is that, 1, 2, 3, 4 or 5 of the best trading days of the entire period just by being out of the market. And by missing those recovery days, you just crystallize losses in the midst of volatility. And that's really what we hope to avoid as much as we possibly can. So we want to be able to live through these periods of volatility. We want to be able to generate whatever liquidity we need in the short term to cover your philanthropic needs. But we want to build portfolios that can be resilient through these kinds of drawdowns, so that we don't get caught in this kind of wash where we can't take the pain anymore and we sell right here in early February of 2009 and we miss a pretty dramatic run up. And the same thing to the COVID shock. These days are really closely cropped together, and it can make trying to make changes in very volatile markets rather dangerous to your long-term success. So just briefly here, when we also want to take a long-term view. So over most monthly rolling periods, 62% of months are generally positive in global stocks, 38% of months are negative. So most of the time, stock markets go up, and that's helpful. Over rolling 1-year periods, about 75% of the time, global stocks go up. Over rolling 5-year periods, Only 12% of the rolling 5-year periods from 1987 to 2025 were actually negative in return. And over the rolling 10-year periods, only 1% of those rolling 10-year periods were negative. So keeping an eye on the long term, reminding yourself that your long-term money is allocated in such a way to support needs today as well into the future. So another way to look at that or to think about how we position and help position you for these more volatile periods is to do so through diversification. And one of the ways that we do that is we diversify both across US and non-US stocks. And so what this chart shows, this is in the calendar year since 1971. The pink bars to the bottom suggest that EFA outperforms, or EFA being the proxy for developed non-US equity markets. And the green bars on the top shows when the US outperforms, and the magnitude of that performance is, measured by the depth or height of those bars. And you can see that, over various points in time, basically this is about the scope of my lifetime, you can see that there's been changes in leadership. And sometimes non-US stocks have led quite dramatically. And sometimes US stocks have led quite dramatically. And here more recently, since the end of the global financial crisis, US stocks have basically led. And they've had a really consistent outperformance, more or less, versus non-US stocks up until this first quarter of 2025. So we do think that's something to be mindful of. The US certainly is exceptional. We certainly have some significant advantages from both a business and stock market standpoint. But we need to be mindful of the fact that cycles change. And in fact, some of the strongest or more durable periods of non-US returns or superior returns have come after strong periods of US stock market returns. So in the early and mid 1970s, we came off in the 1960s and the Nifty 50 stocks. And the US stock market got relatively overvalued, and we saw it trail and not perform well at all through the 1970s. And then following the tech media telecom bubble here at the end of the 1990s, we saw, again, US stocks had gotten relatively overvalued, and as a result, we saw them pair off and not have great performance. And then we have seen an extended period here, and I'm not suggesting I know for certain that we'll have a string of non-US market environments, but the US stock market continues to be relatively overvalued from a stock market valuation perspective, and there is some negative momentum. So again, we think that history might not repeat itself, but we think it rhymes. And so having the diversification of non-US stocks alongside our US stocks, I think will continue to add value. This is a bit of an eye chart, so I won't spend too much time here, but other than to say this is just a colorful reminder that asset class leadership changes and sometimes changes quite violently in terms of what leads. And so this is a somewhat obscure sector, but I think it's a great one to start with, or just use as example. US REITs, it's the third box down in the 2019 column, was up 28.7% in 2019. It was the third best performing asset class. And in 2020, US REITs were down 5%. It was the worst performing asset class. And then in 2021, it jumped right back up to number 2 to 41%. And then followed that in 2022 by being down 25%. So leadership can and does change pretty meaningfully over time in terms of asset classes. So we want to have exposures in the right size and the right direction across asset classes to make sure that we can be where we need to be to get an optimal return while also trying to control our overall level of risk. So that was pretty quick. And so hopefully you'll have some questions for me in the Q&A section, but that gives you a sense of what we're thinking about and how we consider and talk about diversification in overall portfolios. I think I will pivot here and go through our review of standard pool performance, which I'm happy to say has been overall quite strong for the first quarter and really pretty solid for the last 3 calendar years. So I mentioned that the yield curve, yields had fallen. That was primarily at the longer end of the curve. So the yield curve did flatten. That is to say, there was not a lot of premium for taking maturity risk or buying longer term bonds. But we did see, generally speaking, bond yields did fall in the first quarter, and so that generated positive results. So our liquid reserves, which is our money market option, that's a U.S. Treasury money market, up about 1% over the period. The low duration, that's a duration of, so call it 2 years. There's some maturities in the 1 to 3 year range on average. So the shorter end of the curve performed really pretty well, up about 1.5%. And then income and growth, which is our 40% equity, 60% donor option, benefited from that 60% fixed income allocation and was up about 1.3% for the quarter. So really pretty strong performance from our most conservative options. When we take a look at our longer term options and those options that are invested entirely in public markets, we say that the passive alternative, these are all the passive long-term growth, active long-term growth, and ESG long-term growth are all basically the same exposures of 75% stocks, 25% bonds, with generally similar underlying, capitalization allocations and the like. And so we can see the passive alternative was basically flat for the quarter, so that that global equity market return will dominate this portfolio. But good performance out of the fixed income allocation allowed the portfolio to be basically flat and basically flat to its benchmark. Excuse me, active long-term growth, which combines passive with active implementation in the portfolio, benefited significantly from the strong performance of primarily the non-US and emerging markets equities allocations, as well as the 25% allocation to fixed income. And so strong active performance from both of those positions, both of the sets of managers outperformed those categories. And so in a market where global equities are down for the quarter, seeing our blended portfolio here up 40 basis points and ahead of its target weighted index makes us very happy. The ESG portfolio, a little bit less solid performance. There are some factor notions, or there's some general market exposures that are more common in ESG that cause a bit of a tilt to the ESG portfolio. We see that periodically, and in some markets that can really help. In the first quarter market, that didn't help all that much. So it did underperform a bit, modestly negative in the quarter versus its policy index. And then when we look at diversified long-term growth, again, this is our most diversified portfolio. So it has the same, building blocks from a traditional perspective as the active long-term growth, but has the advantage of, or I shouldn't say that. It has the additional diversifying benefits of hedge fund portfolios, as well as private equity, private real estate, private debt. Benefited again, a little bit less public market exposure than the active long-term growth, which helped protect capital in a down market. And then continued strong performance, not only from those components I mentioned earlier in the active public international, but also really strong performance out of the hedge fund portfolio in the quarter. So this is what we would expect to see on average, is to see diversified long-term growth to outperform the public-only options in a down equity market. And in very strong up equity markets, we would expect to see diversified long-term growth trail. And we see that in the 2023 environment, where there was a pretty meaningful difference given the absolutely phenomenal up market returns that we experienced in 2023. So with that, I will pause and open the floor to questions. And actually, I will stop sharing so you can see us all. And love to take any questions that you might have.
Let me pull up the Q&A page. Wait just a moment. Just a question from me that, you mentioned international emerging markets has outperformed the start of the year. Do you think it can and will continue? We've talked about valuations in overseas being prime for good returns over the past 10 years, but it looks like it's actually coming true. I know you don't have a silver ball to look into, but what do you think?
So I mean, there are certainly some characteristic advantages that are suggesting that. Oops, sorry. I guess I was sitting too still for too long. There are some characteristics in the outside the U.S. that suggest we could get some momentum in non-U.S. I think valuation is one of them, although non-U.S. markets have been cheap for a long time. Valuation as a timing tool is just not it's not effective. But all things being equal, non-U.S. markets are still more attractively valued. And so if positive momentum continues in that way, that we should have the setup for good outperformance of non-U.S. The question is to what magnitude. It's very hard to say because so much of the shorter term will be driven by sentiment. And so you even see that in April, right? The tariffs were announced. Investors took a very harsh look at that and sold off pretty significantly expensive U.S. assets. And really even not even just expensive U.S. assets, basically sold off U.S. assets. Which perhaps got some momentum from non-U.S. owners of U.S. assets as the dollar weakened, because that sort of doubled their pain on the way. But if the tariff levels settle into something somewhat, I don't know what reasonable is, right? It's some level that's not 145%, but some level that could be digested relatively easily by consumers and businesses over a short period of time, then it just comes back down then to growth fundamentals of the U.S. versus non-U.S. companies. And, we've seen reform in Germany for them to be able to do more government spending. Certainly the change in U.S. administration's view on global defense has caused European countries to have to rethink and realign their expenditures on defense. And so you could see some of those things where dollars are going to have to be spent or will be spent in Europe, driving perhaps strong economic growth. And maybe that coupled with cheaper valuations could drive some continuation of the leadership. But while all that is reasonable and sounds great, it's just impossible to know today. Certainly, it's probably impossible to know all the time, but it's certainly impossible to know today with not knowing what the final rules on tariffs will ultimately look like. If it stays messy with the U.S., then it would seem very reasonable to me that you could see some non-U.S. strength for a few more months if messaging or delivery or execution of all of that stays in a bit of a guessing game, right? I hate to use the word chaotic, but at times it's been chaotic. So if that continues, you certainly could see investors looking for calmer waters, and perhaps non-U.S. securities would be a place where they'd look.
Yeah, and a big piece of that year to date has been the weaker dollar, adding to returns for non-U.S. stocks. When we look at, developed markets for the first quarter, I think they were up 2.93% in local terms. But for U.S. investors, that return came close to 7%. And then EAFE was flat in April, but in U.S. dollar terms, we'll see about 4.5%. So reinforcing kind of what Travis said, all of that volatility also makes the dollar less attractive. And that has contributed to returns year to date.
Great point, Tim. Love to take any more questions from the crowd. Still got good numbers hanging in there.
Yep. Any other questions? All right. No questions from the crowd.
All right. Well, from our perspective, thanks again for joining us. If you have a question come up afterwards, feel free to reach out through Natalie and her team, and we'd be happy to put down some thoughts in support of that. So, Natalie, thanks for having us.
Yeah, thank you, Travis and Tim, for being with us today and your insights. And to all our participants, we hope you found the webinar informational. And a reminder, we'll be posting the recording on my FFTC / resources as soon as possible. And feel free to reach out to me directly with any questions as well. My email is on the website. Thank you and have a great day.
Thanks all.